Next up, we have Alan Ellman. Our next speaker, he's the owner of BlueCollarInvestor.com. His expertise resides in cover call writing, and that is what he is going to cover today. Alan is a national speaker, and you may have seen him at the Money Show or AAII. He has published 4 books, over 300 published articles, over 150 videos. Ladies and gentlemen, without further ado, let me bring you Alan Ellman.
Thank you, James, and thanks to Josh and Joe for those great presentations. For those of you attending today's webinar, I appreciate your attendance. You could type in questions, and Barry Bergman, our Director of Research, will respond to those questions, and he'll show the answers to everybody out there attending this webinar today. My topic is creating a monthly cash flow with a strategy known as covered call writing. And for those of you new to the strategy, it embraces 2 other strategies, one of which you're familiar with, and that's buying stock. And the other one is selling options. And I'm highlighting the word selling because that implies that we're going to be creating a cash premium from the sale of those options, and that is precisely what covered call writing will do for us. It will create a monthly cash flow while keeping capital preservation as a key priority. Okay, so for those of you who are new to covered call writing, let me get you started with a preview example, so then as we go through the basic and more advanced principles of covered call writing, this information should all come to life. And in this preview example, what we're going to do is we're all going to purchase 100 shares of stock. It could be any company. We'll call it company XYZ, and we're going to spend $48 per share. So our investment or cost basis is then $4,800. Now, once we own these shares and we're in a covered or protected position, we are now free to sell the option. What we're doing here is we're selling some unknown person, because everything's done online, the right, but not the obligation, to buy our shares from us at a price that we determine, by a date that we determine, and in return for undertaking this obligation, we are paid a cash premium that the market determines. Now, in this hypothetical, we're going to buy the shares for $48 and agree to sell them for $50 at any time over the next 1 month. And the reason I sell 1-month options is, the main reason anyway, is that I found over time that I make the most money with 1-month options. Now, a typical premium in a situation like this would be about $1.50 per share, or $150 for the 100 shares. Now, a $150 initial profit on a cost basis of $4,800 represents a 3.1% 1-month return. If we could do that every month, that would annualize out to 37%. Now, at the end of the 1 month, there are 2 possible major outcomes. In the first scenario, let's assume for a moment that the price of the stock never supersedes the agreed upon $50 sales price. Let's assume it stays at $48. Well, the option buyer is not going to exercise that option and buy our shares from us at $50 if they could be purchased at market for $48. So the option expires worthless. We keep the $150 no matter what. So let's put that out on the table right now. The cash generated from the initial sale of the option is ours to keep no matter what. Now, in this case, we've generated a 3.1% 1-month return on the option side. We still own the shares, and now we're free to sell another option the next month. In the second possible major outcome, let's assume the price of the stock does go past the $50 agreed upon sales price. Let's assume it goes to $52. Well, the option buyer is then going to exercise the option, buy our shares from us at $50, turn around and sell it at market for $52, and thereby generate a profit. However, we are the option seller, so let's look at this trade now through our eyes. We generated $150 from the sale of the option. I told you that that's ours to keep no matter what. Now we've generated an additional $200 on the sale of the stock. We bought at $48, we sold at $50 times 100. Our total 1-month profit is $350, and that represents a 7.3% 1-month return. Now, if we could do that every month, that would annualize out to 87%. But let me stop and tell you right now that you are not going to get this type of return on every single trade in your portfolio every single month. However, in normal market conditions, and particularly in bull market conditions, you will get a few of these in your portfolios. It will not be unusual. Now, I know Joe went over some of these definitions in his presentation. There are certain ones that are specific for covered call writing. There aren't a lot, but I'd like to review them with you now, so then as we go through the procedure, it'll all have meaning. And for those of you not familiar with these terms, I will be repeating them throughout today's webinar. So first of all, what is an option? Well, an option is a contract that gives the holder the right, not the obligation, to buy or sell 100 shares of stock at a fixed price called the strike price, and that was $50 in the preview example, by a specified date, that's called the expiration date, and we sold a 1-month option in the preview example, and most options expire on the 3rd Friday of the month. So for example, for the May contracts, Expiration Friday was yesterday. Now, a call option, which is all we're going to be dealing with today, gives the holder the right to buy 100 shares of stock at a specified price. A put option is the opposite. It gives the holder the right to sell 100 shares at a specific price. We will not be dealing with put options in today's webinar. Now, the next 3 definitions relate to the option strike price. Remember, that's the price we agree to sell our shares for, as it relates to the price of the stock. And we have 3 definitions here. At the money is where the strike price is the same as the market value of the stock. As an example, we buy a stock for $50 and agree to sell it for $50. Yes, folks, we're actually going to get paid for that. In the money, which is the one that's the most difficult to understand as it relates to covered call writing, yet is the one that's going to put cash in your pocket if you learn how to master it. You'll see examples in today's webinar. That's where the strike price is lower than the current market value of the stock. As an example, you buy a stock for $56 and agree to sell it for $50. Well, you may be thinking, why the heck would we do that? The answer is the premium that we're going to receive from selling that option is going to compensate us for that $6 difference plus a little bit more. It's that little bit more that represents our profit, not the $6 that we're going to lose on the sale of the stock. And I'll break that down in the next slide. Finally, the out-of-the-money strike, and that's the one that I used in our preview example where we bought a stock for $48 and agreed to sell it for $50. And that is by far the most popular of all the strike prices, and we'll go through when and where to use each of these strike prices when we're using covered call writing a little later in the webinar. We have 2 more definitions here. The option value, that's the premium generated by selling the option as it relates to the price of the stock. Now you can see at the bottom of the screenshot the equation that the option premium consists of intrinsic value plus time value. Now, intrinsic value applies only to in-the-money strikes. The example I gave was you buy a stock for $56 and sell it the $50 strike. So the intrinsic value on that premium is $6. So if we generated a total premium of $8 from selling that option, that breaks down as follows. Of the $8, $6 is intrinsic value, the amount that the $50 strike is in the money, plus $2 of time value. Now, of that $8, our initial profit is $2, not $8. If you are using covered call writing and you count $8 as your profit, you are exaggerating your returns. Now, let me stop and give you a little bit of good news here, because the maths may seem a little complicated at this point. At the end of the presentation, I'm going to tell you how you can all get a copy of the Ellman Calculator, which will do all the math for you. So the math will become a non-issue. Okay, so just to summarize here, with covered call writing, we're buying stocks and then we are selling the call options on a share-for-share basis. In order to sell one options contract, you must first own 100 shares of stock. If you wanted to sell 5 contracts, you would then have to first own 500 shares of stock. Now, before you decide on risking your hard-earned money, you must have reasons why you're using a certain strategy. And the reasons should not be that I said so, or some screaming guy on TV told you to, or some newsletter told you to. It should be because you've educated yourself, you've done your due diligence, and you've made an informed, non-emotional decision based on sound fundamental, technical, and common sense principles. Now, I've been using this strategy for about 20 years now in both my accounts and in my mother's portfolio. And on the screenshot, you could see the reasons why I sell covered call options. I've highlighted 4 of them. I'll discuss those 4. The rest you could read from the screen. First and foremost is that of all the low-risk strategies I've tried, I get the highest rate of return with covered call writing. The second highlighted reason is that you can control your results through the use of exit strategies. I've actually written an entire book on this one subject, the only book ever written on this topic that's devoted solely to position management with covered call writing. What if the price of the stock goes down? What if the price of the stock goes up? What if there's a dividend distribution? There are so many things that can happen in that 1 month, and you need to know how to react so you can maximize your returns. The amount of control that you have with this strategy is amazing once you master that element of the strategy. The third highlighted reason is that you can compound your money in minutes. What that means is when you sell the option, the cash is generated into your brokerage account instantly and there for you to use either right then and there or the next day depending on the broker. Now, assuming I'm going to use a large account now, you have an account of $300,000. Let's say you generate $10,000 a month from selling covered calls. You could take that $10,000, immediately purchase new shares, and then sell call options on those newly acquired shares, thereby compounding your money in minutes. And finally, the last highlighted reason, and actually the reason that got me attracted to this strategy, was that the government considers this strategy appropriate for use in your self-directed IRA accounts. So if you're questioning how risky is this strategy, that's really all you need to know. But let me highlight this for you. This is not a no-risk strategy. This is a low-risk strategy. Now, I would be remiss if I didn't tell you the disadvantages of covered call writing. Every strategy has its pros and cons. There is no free lunch out there. So let's go through this slide now, and we'll start with the obvious. If the price of the stock drops below the break-even, you could start to lose money. Let's go back to our preview example. We bought a stock for $48. We sold the 50 call for $1.50. Our break-even then is $46.50. The price of the stock starts dipping below $46.50. We could start losing money. That, folks, is where our exit strategies kick in. Number 2 is really the main reason, the main disadvantage to covered call writing. So please focus in on this one. Your profit potential is limited by the strike price. Here's what I mean by that. Back to our preview example. We bought a stock for $48 and we agreed to sell it for $50. Let's say some unexpected good news comes out. Dividend distribution, stock split, new contracts, whatever. Price of the stock goes to the moon. In 1 week, it's $60. Well, we've agreed to sell it for $50, and we'd love to get our hands on those extra 10 points, but we cannot. However, as I say on the slide here, don't get greedy. If you've generated a 7% 1-month return, simply pat yourself on the back, say, nice job, Alan, take the cash, and move on to another covered call position. Number 3 is assignment. That means your shares can be sold because the option holder has the right to actually buy your shares from you. Well, 99.9% of the time, That will not happen until the day after Expiration Friday. And you can avoid it from happening, as I will show you at the end of the webinar when we discuss exit strategies. However, a rare exception is when there is a dividend distribution, your shares may be sold early. There are also ways to avoid that, and that's in my material that I'll be discussing later on in the webinar. But in my world, if a stock is sold early, I could care less, because that means I've maxed out my trade, and now I have the cash in my account to enter a new position, sometimes even in the same month with the same cash. And finally, number 4, which probably applies to all strategies, is that there's a learning curve and a time commitment. Now, for those of you completely new to covered call writing, I've dealt with thousands of covered call writers all over the world. I could tell you that the average person new to this strategy will need about 3 to 4 months to master the strategy, paper trade or practice trade, and then you're good to go for years and decades. So the first thing you want to do is, what stock should you choose for selling your call options? There are some specific criteria that I have set up that's detailed in my books and DVDs. I don't have time to go into detail, but I'm happy to share with you the screens that I use in the BCI methodology. And the first 2 are from Investors Business Daily. The IBD 50 list are growth stocks that have tremendous technical upward momentum. I've had a huge amount of success with these stocks over the years, and I always screen these 50 stocks, and my team screens them for our premium members every week. Then we run them through the IBD Smart Select ratings, and those are a screening process that involves both fundamental and technical screens, not only for the stock, but also for the industry that the stock is in as well. And finally, the MSN Scouter rating, which is a risk-reward screen. What they've done here is taken 10 years of historical data, they've quantified it and created equations, and then a ranking system 1 to 10. The higher the number, the more likely the stock is to outperform the market over the next 6 months and with the least amount of volatility. In the BCI methodology, we require a Scouter rating of 5 or better. Now, in addition to the fundamental screens and the technical ones that I'll be discussing in a moment, I have a series of common sense screens that we run our stocks through as well. And the most important one is the first one on your screenshot here. So let me underline this and highlight it. Never, ever, ever sell a covered call if there's an upcoming earnings report prior to Expiration Friday. That's a hard and fast rule. And when I show you what our premium stock reports look like, you'll see how the BCI team tries very hard to make sure our members are aware of which companies may have passed our screens but are reporting, and therefore you have to wait till after the report to sell the option because there's way too much risk with an earnings report. There are also a few companies, about 10 companies on U.S. exchanges that report monthly same-store retail sales on a monthly rather than a quarterly basis. So those companies are banned permanently for consideration for covered call writing. And at the end of the webinar, I'll tell you how you can all get a free copy of that list as well. Last couple things here. We require a minimum trading volume of 250,000 shares per day, and no one stock or industry should represent more than 20% of your portfolio. And finally, you should try to allocate a similar amount of cash to each of your positions. So as far as stock selection is concerned, there are 3 prongs: fundamental analysis, common sense principles, and now technical analysis. And in the time allotted for my webinar today, we can't go into too much detail, but I'm happy to share with you the screens that I use and the BCI team uses when we're screening for eligible stocks for covered call writing. The first one is exponential moving averages, and that identifies the trend. It's the stock price going up, down, sideways. Then we have 2 momentum indicators. They're called the MACD histogram and the stochastic oscillator. That tells you, is the price movement momentum going up, down, or sideways? And finally, we look at the volume to see if it's confirming those other indicators or if we have any divergence between the trend and the volume. So this is what a typical chart will look like when we're screening our stocks. And at the top, you could see the moving average is uptrending. So we have a bullish signal here. Now, as far as the MACD histogram, that's these blue bars that you see here. We like to see them above zero, which is the case, and we'd like to see them ascending, which is not the case. So we have a mixed MACD histogram signal over here. And down over here, that thick black line is the stochastic oscillator. And we like to see that ascending and bumping through the 20th percentile. Well, it bumped through the 20th percentile here, and it's lately been descending. We have a bearish stochastic oscillator signal over here. And let's have a look at the volume. This is very interesting. As the price of the stock is accelerating, the volume is declining. So what that means is if this price acceleration was our rocket ship and the volume bars was the fuel, that means we may be running out of fuel and there could be a change in the trend. So there's a red flag here also. All in all, we would view this as a mixed picture. So what does all this mean? Well, if we decided to use this stock in our portfolio in the current month, we would then sell an in-the-money strike, which will give us an insurance policy on the time value of our option premium. Now, folks, that was a mouthful, but I'm going to break it down with actual numbers using the Ellman Calculator as this webinar continues. The takeaway here is I'm more likely to sell an in-the-money strike, the example we gave, buy a stock for 56 and sell the 50 call, if the chart technicals are mixed. If they were completely negative, I would not use this stock. And if they were completely bullish, I would be more likely to sell an out-of-the-money strike. Here's a look at what our premium report looks like, whether we do it for you or you do it yourself, because in my material, I'll tell you exactly how to screen the stocks. It goes through the whole process of fundamental, technical, and common sense screens. And then in the middle of our report is the actual watch list. We call it a running list because it's in a constant state of change. And you could see here in the top row, Google at the time was highlighted in gold because that means there was an earnings report that month, and you need to avoid that even though it's past all the screens until the earnings report passes. You could see here we give the earnings report date and a lot of other information like the industry name and rank, dividend information, beta information, and much, much more. So having a quality watch list is more important than looking and seeing what your option returns are, because you should never sell a covered call option on a stock that you wouldn't otherwise want to own. Okay, so at this point, what we've done is we have generated a watch list of the greatest performing stocks in the greatest performing industries, stocks that we would otherwise want to own. But we haven't yet made a penny, and that's why we're all here today. So in order to figure out how much cash we could generate from the sale of our options on these stocks, we have to access an options chain. And an options chain is simply a list of options prices. And whatever broker you're using, they will have this information for you. And there are also several free sites you could use, like finance.yahoo, cboe.com, and there are many others. Just put in the ticker symbol of the stock, hit the options link, and you will see an options chain that looks like this. Now let me give you some orientation here, and then we'll do some calculations. Nuance Communications, NUAN, at the time on the upper right, you could see the price was $24.07. Now on column 1 on the left, those are the strike prices you can choose to sell the stock for. I've highlighted the out of the money, higher than the current market value, 25 strike. Now the column 2 is the ticker symbol of the option. And I don't know how clear it is on your screen, but it consists of the ticker symbol of the stock, the expiration date, the strike price 25, and there's a little C in the middle, which means it's a call option. Column 3, all the way to the right, tells you the option liquidity or open interest. how much interest does this options contract have? We require a minimum of 100 contracts. Here you can see over 12,000 for this one. Now, as far as the cash generated, we have to look at the bid-ask columns. We sell at the bid, the lower. We buy at the ask, the higher. Now, the difference is pocketed by the gazillionaire market makers. They make the difference in the bid-ask spread. And a lot of times we could negotiate a better price with these fellows, and that information is in my material how to do that. But for purposes of this webinar, we're going to go with worst case scenario, and we're going to go with the published bid, which is 75 cents. So $75 per contract on an investment basis of 2407 represents a 3% initial return. Now, if Nuance should go from 2407 to the 25 strike, have we not then generated an additional $93 in profit, or another 4%? So in this particular case, we have the possibility of a 7% one-month return. Now remember, we only use time value when calculating our profit, and the Ellman calculator will deduct any intrinsic value from the option premium should you sell an in-the-money strike. Now here's an old slide that I keep in my presentations for a reason I'll explain in a moment, of Apple Computer when it was trading at 205.93. Now I went down to the 210 out-of-the-money strike, and you'll notice here on the symbol column that it looks very different than the option symbols in the last slide and all the rest you'll see today. And the reason I put this slide in is I want you to know that if you ever buy a book on options, like my first two books, for example, the option symbology was different than it is today, not as user-friendly. Okay, that being said, the 210 out-of-the-money strike generated $815 per contract, which is about a 4% one-month return. Now, should Apple go from 205.93 to the 210 strike, we've generated another $407 in profit, or another 2%. So in this case, we have the possibility of a 6% one-month return. Here's Tupperware, trading at 44.14, out-of-the-money 45 call, generated $1.85, or 4% one-month return. And if Tupperware goes from 44.14 to the 45 strike, that's another $86, or another 2%. So as in the Apple example, we have the possibility of a 6% one-month return. Now, here's the Ellman calculator at work. You can see the blue cells on the left are the ones that you fill in from the information gleaned from an options chain. So at the bottom row, I highlighted in yellow, VIT was selling at 1873. All you have to do is feed in the blue cells, and the white cells become populated. The $20 out-of-the-money strike generated 90 cents, okay? And the expiration dates are all the same here. Now the white cells become populated. So it says upside $1.27. So what does that mean? Well, that means for every share you can generate an additional $1.27 in profit if the price of the stock goes from 1873 to the $20 strike. Now the return on the option or RU is 4.8%. That's 90 divided by your cost basis of 1873. That's your initial one-month profit. Upside potential is that if you do get that additional $1.27, that represents another 6.8%. So in this case, you have the possibility of a whopping 11.6% one-month return. Now, let's have a look in the row above that. We had the same stock price of 1873, but instead of the $20 strike price, let's go with the in-the-money 1750, and that generated $2.15. Can we count that entire $2.15 as profit? No, we cannot. Why? Because we're going to lose $1.23 on the sale of the stock. We bought it at 1873. We agreed to sell it for 1750. The white cells become populated, and it tells you that the intrinsic value of $1.23 is going to be deducted from the $2.15, and that will give you a return that's time value only of 5.3% for the month. Upside potential? None. That stock can go to 100 We've agreed to sell it for $17.50. Now, here's the important thing, folks. Downside protection. This is not break even. This is downside protection of the option profit. What this means is the following. We are guaranteed a 5.3% one-month return as long as share value does not decline by more than 6.6% by Expiration Friday. Stated differently, we are guaranteed that 5.3% one-month return as long as the current market value of 1873 does not drop below the strike price of $17.50. If your overall market assessment is bearish, if the chart technicals are mixed rather than bullish, we would tend to favor the in-the-money $17.50 strike, which gives us a beautiful one-month return and an insurance policy on top of that. Now, folks, here's the beauty of that insurance policy that makes it different from every other insurance policy that you have. This one is paid for by the option buyer, not by us. Here's a strategy that I use in my mother's account where I sell options on exchange-traded funds. ETFs are mutual funds that behave like stocks, and many of them have options associated with them. So here we have the Qs, which represent the 100 largest non-financial companies on the NASDAQ exchange. And at the time, the Qs were trading at 45.85, and I went to the 46, slightly out of the money. It's really considered near the money when it's that close. 46 call, which generated 87 cents. So we feed that into the Ellman calculator, and we see that we get a 1.9% one-month return with the possibility of another 0.3% if the price of the security goes from $44.85 to $45. So we have a possibility here of a 2.2% one-month return, still not too shabby. Now, one thing you may see here is that when you're using ETFs, the returns are going to be lower than when you use individual stocks, generally speaking, and that's because the volatility of a security that consists of a lot of stocks is lower than that of an individual stock. So there are certain advantages to ETFs. There's less management. You need less cash to get started. But on the other hand, your returns will be lower. This is more appropriate on my mother's account. I use individual stocks in my accounts. Okay, so let's talk about management now. Management doesn't start after you enter your position. Actually starts before. We went through this. Stock selection, strike price selection, which I'll get into in a moment. And we also have a whole series of exit strategies that we're going to use to manage our positions if the trade should either turn against us or turn out much better than we anticipated. So let's start off with strike price selection, and some of this will kind of sound familiar because we've gone over some of this. In the money strikes. This is the most conservative covered call writing position you could take. The example we gave is we bought a stock for 56 and sold the 50 call. We use these when we're concerned about the market, we have a bearish outlook, or it's a volatile market, or when the chart technicals are mixed. We have that insurance policy on the option profit paid for, thank you very much, by the option buyer. At the money strikes is a bullish position. The example we gave, buy a stock for 50, agree to sell it for 50. It will generate the highest initial return, give us no upside potential, and no downside protection of the profit. Yes, we have a break even, but I'm talking about protection of the profit. I'm not interested in breaking even. The out of the money strike, which is the most popular and the most bullish of all covered call positions, and the one you should always try to use if possible, but only when appropriate. And the reason it's so popular, and let me first refresh you on the example we gave, we bought a stock for 48 and agreed to sell it for 50, is that it can generate two income streams in the same month, one from the sale of the option and the other from share appreciation. And that's why that is the most popular strike price. Let's use an example here of a stock trading at 37.03. Here's a real options chain. We'll look at the 35, 37.50, and 40 call. Keep these numbers in mind now. These premiums were 285, 145, and 55. On the upper right, I've highlighted those strikes and premiums, fed it into the multiple tab of the Ellman calculator, and we get our results. Now my goal is 2 to 4% a month, and you could see here that the top two reached that goal. If I was very bearish on the market, I would go for the 35 strike, which guaranteed me a 2.3% 1 month return as long as share value does not decline by more than 5.5%. If I was bullish, I would go for the 3.9% initial return with the possibility of another 1.3% if share appreciation goes from 37.03 up to the 37.50 strike. So there's a lot of thought that goes into both stock selection and strike selection. So at the end of this webinar now, we're going to get into a brief discussion of exit strategies. 5 things that can happen to the stock price. We're going to keep it simple, folks. The price can go up a lot. We win. We generated the cash from the option sale and any share appreciation from the purchase price up to the strike price. The price can go up a little. We win. We generated our option profit and whatever share appreciation from the purchase price up to in between the strike price. The price stays the same. We win. We've generated our option profit. We still own the shares, and we're now free to sell another option. The price goes down a little. We probably win. If we generated 3% on the sale of the option and our share price went down 1 to 2%, we still have a 1 to 2% profit. And finally, the one I want to concentrate on, the price goes down a lot, we can lose, and that's where our exit strategies kick in. I'm going to give you 2 examples. There's so much more to learn, but I want to get you a feel for how much control we have when we're using this strategy. And in my books and DVDs, I break down exit strategy into 2 time frames, the first half of the contract and in the second half. Here are some of the strategies you could use in the first half, and all exit strategies start with the very same thing. You buy back the option. We're going to talk about a strategy I call hitting a double. Hitting a double simply means is that you are going to generate 2 income streams in the same month on the same stock with the same cash simply by being a good Boy Scout and being prepared. I have what's called a 20%, 10% guideline. In that, we always buy back the option when the value reaches 20% of its initial value in the 20% or less, I should say, in the first half of the contract, or 10% or less in the second half of the contract. Don't worry too much about it. It's all in my material. Okay, in this example, on Valspar, I sold the initial option, STO means sell to open, at 410 where the green arrow is on the left. Price of the stock went down, all that great screening, it still dipped down. Now, it was early in the contract, and the reason it went down, it was pulled down by the entire market going down. It wasn't an individual company issue. So I decided to buy back the option. BTC means buy to close at 85 cents, which meets my 20% guideline. And I decided to wait to see if it bounced back up. And lo and behold, it did. Now, had it not, I would have used a different strategy like rolling down. I was prepared for both scenarios. In any case, I sold the same option at 310. So let's take a deep breath and have a look at this trade. Take the 410 initial premium and just put that in your pocket, and let's not even look at that. After I've generated that profit, I then had an option debit of 85 cents to close the position and an option credit of 310 to reopen the same exact position. Net net, in this half of the contract, I had a profit of $225 per contract. Hey folks, if you had 4 contracts, that's $900 for simply being prepared. Now, let's take it to Expiration Friday. And what I need to tell you here is that if the price of the stock is even 1 penny higher than the strike price, 1 penny, your shares will be sold on that Saturday after Expiration Friday unless you take action. Now, you can avoid this by rolling out or rolling out and up. Now, I'll explain that in a moment. But before you decide to roll the option and not have your shares sold, you must first make sure that the stock meets all your system criteria. And the most important thing you need to check is to make sure there's no earnings report coming out in the next month. Remember, all exit strategies start by buying back the option. So here's a real-life example. Now, I always sell my options in multiple contracts. We're going to use one to keep the math simple. I bought 100 shares of ARMH at $32.10, sold the out-of-the-money 33 call at 80 cents. That generated an initial profit of a one-month profit of 2.5%. Now, the price of the stock on Expiration Friday was $34.31, well above the 33 strike. My share profit was going to be $90 from $32.10 to the strike. So my total profit that month was 2.5% on the option side, 2.8% on the stock side, total 5.3%. Okay, put that in your pocket, put it in the bank, forget about it. Now we have to make a decision. Are we going to roll that $33 option to the next month? Here's the options chain for that current month and the next month. Remember, we buy at the bid, the left column. We sell at the bid, the left column, buy at the ask, the right column. So we would buy back that option at $1.35. Move on to the next month, the 33 strike is selling at $2.10. There is a tab on the Ellman Calculator that will do all this math for you, and it's called the What Now tab. Again, I'll get you a free copy at the end of this webinar. And what the Ellman Calculator tells you that if you did this rollout strategy, that you are guaranteed a 2.27% one-month return as long as share value does not decline by more than 3.8% by Expiration Friday. If that's a trade that meets your goal, you're going to roll the option. If not, allow assignment, use the cash on Monday to enter a brand new position. Now, a lot of you may have questions. I don't know, you may have already asked them to Barry about strategies related to covered call writing. There are a lot of them. It's all in my material. But traditional covered call writing is what I do most of the time. But there are other similar strategies that are also very, very good. Now, I want you to write this down because we're going to offer you some discounts on some of our material. The two promo codes you want to jot down are Inspiration 10 and Inspiration 50. Inspiration 10, when you go to my website, you'll get a 10% discount off any of the educational material on our website, books, DVDs, and we're offering a deep discount on our most popular package, which I'm going to show you in a moment. And these promo codes are active for today and tomorrow only. Here is the package that's our most popular, most comprehensive. You will need nothing else. Normally sells for $4.19 on our website, $3.69 using Inspiration 50. It's my third book, The Complete Encyclopedia for Covered Call Writing. It's been the #1 best-selling book on covered call writing on Amazon.com for the last 2 years since it was published. Our latest DVD program, which also has a workbook of all color slides, charts, and graphs used in 3 live seminars, and a month of free membership where you get those stock reports, which you can activate at any time. We'll ship it to you for free. Now, as far as the free resources that I promised you, you go to my website, thebluecollarinvestor.com. Remember to type in the THE first. We're on the circle on the middle of the page, free resources, including the Ellman Calculator. You can download the calculator right to your computer. There's also a user guide you can download, and all those files that we talked about. Also, everything is free. I've also written a glossary for terms. You may want to bookmark that, all the terms you need to know for covered call writing. And on the upper right, you see this gold banner. It's become one of our most popular free resources next to the Ellman Calculator. It's an 8-part video series that I produced with free PowerPoint downloads. Just put your name, email address in, and you could start taking this beginner's tutorial. Many of the slides and graphs you saw in today's webinar are included in that Beginner's Corner webinar. We also have a free newsletter. Go to the blog on my page, fill in your name and email address. I spend hours a week writing my blog articles. They will be well worth your time if you're going to use this strategy. That will be delivered to your email address Sunday mornings, 10 a.m. Eastern Time every week. That, folks, is my presentation. I don't know if we got to all the questions. Get a little help from the fellas in the background.